I'm Paul Hickey, and I am doing a presentation on the 9 benefits of doing a small cap IPO and why it may be better than a BC or D round. And I capitalized may because I'm certainly not saying that all companies that are doing $100, $200 million in revenue should do an IPO. But it should be a consideration, and that's really the point of my presentation today, is to give you the information so that you can do the cost-benefit analysis of should I take $100 million from a VC or possibly do a $100 million IPO. And hopefully by the end of this presentation, I'll give you a lot of information so you can make that kind of a decision. One of the interesting things about the industry that's changed over the last 10 years is there's this notion that you have to be a unicorn, which is a company worth $1 billion or more, before you can IPO. That is not true. By the end of the presentation, you're going to see that. But I think one of the reasons that that emerged is back 10 years ago, there was so much money coming into the VC world when money was basically free. And VCs had so much money to deploy, they were just literally throwing 100, 200, 300, $400 million at private companies and saying, don't do an IPO, take my 400 million bucks, which of course, I don't blame the VCs for doing that. That's how they make their money. But it seems like the whole small cap market got forgot about. So what is the small cap market, by the way? The small cap market, it is simply just the size of your company. So small cap companies are valued between 300 million and $2 billion. Micro caps are 50 million to 300 million. Mid caps are 2 billion to 10 billion. Large caps are 10 billion to 100 billion. And you got mega caps over that. So it just refers to the value of the company. Now, question for you. This is the only question I'll probably ask during this presentation. Which of these 4 companies was a small cap company when they went public? Any guesses? Any? Which one? Amazon? Anybody else? Tesla. It was actually a trick question. All 4 of these companies were small cap companies. Amazon had a total market cap of $400 million when they went public. Microsoft was 700 million, Apple 1.3 billion, Tesla 1.7 billion. By the end of the first trading day of Tesla, they jumped up to 2.2 billion, so they jumped out of it, but they were there for a few minutes. But just to give you an idea, these are all trillion-dollar companies that all started out as small cap public companies. So, and a little more about the small cap sectors. Russell 2000 is an index of the top 2,000 small cap companies. Totals about $3 trillion in value. Of course, there's more small cap companies than the Russell 2000, and then you got the micro cap. So the total market is around probably $4 trillion in small and micro cap companies. And total public markets are about 30 trillion in the United States, NASDAQ and New York Stock Exchange. So it's a pretty substantial market. Here's what we're going to go over today. We're going to talk about the steps of going public. I'm going to really rush through that because that's not the point of the presentation, but I want to give you a sense of what it takes to become public. That's really a much longer couple-hour presentation if you're ever interested in going deep on that. We're going to talk about the costs of going public and the costs of remaining public. I'll just do that briefly. And then we're going to talk about different ways that you can go public. It's through an IPO. You can use a SPAC, an APO. There's actually a few others. We'll talk about why you shouldn't go public. There's 4 reasons that we'll talk about when you're trying to consider should you or shouldn't you. And then we're going to talk about SPACs because there's a lot of misinformation about SPACs. It's not a 4-letter word. And we'll talk about why they've recently developed a bit of a bad reputation. And then the bulk of the presentation is really going to be talking about the 9 benefits of being a small cap public company and what you get out of it and why you should consider it versus a private round. So just a little about me really quick. I'm Paul Hickey. I took my company public, QCOM, back 20 years ago in 2023. That's actually me ringing the bell, the opening bell at the American Stock Exchange. We were a technology company. We built some hardware and software for the prepaid calling card industry. And that was a great experience. And then after that, a couple years after we went public, we got acquired by a large private company that took us private. And so I co-founded a boutique investment bank, Hickey Frachter Advisors, and our specialty was small cap public offerings, raising money for companies that were going public and also small cap companies that were already public. And then for a period of time, we started my partner and I started a pre-IPO fund, Corone Capital. which would invest kind of as a bridge to companies when they are getting ready to go public. So you can see I've been on every side of the transaction. I've been on the management side, taking a company public. I've been on the investment banking side, raising money, and I've been on the investor side, investing in these deals. Just really quick, what am I doing right now? I've got 2 books that I'm writing with a lot of help from AI, should be done in February. One of them is on this presentation, actually, the 9 benefits of a small cap public company. I've also been involved in tokenizing real estate. I've been in that sector for several years. I actually wrote that book in 2019, but it was awful, so I never published it. So now I'm just upgrading it and going to release it pretty soon. And then I'm advising companies, and what I'm doing now is advising companies that are getting ready to go public. I'm open to a board seat here and there for public companies, and then working with developers that want to do raise money through token real estate offerings. So let's talk about what it takes to go public. This is not an exhaustive list, but these are the major things. You've first got to sit down and assess just how close are you to being qualified to be in a public company. You have to have certain revenue. You have to have a certain number of shareholders. So you do an assessment. If the assessment says, yep, you can, with a little work, you can be ready and be a public company, then you go find an underwriter, investment bank that's going to raise the money. They're going to hold your hand through a lot of the process and help you out. That's the stuff that I used to do in helping companies prepare, get ready, do all the things they need to before the offering. You got to hire a law firm that's going to do an S-1 registration statement. That registration statement is what you file with the SEC that eventually they will hopefully approve so that you can then go out and raise the money. That's the shares that the registration statement is also registering your shares to be available to sell publicly. And then you need 2 to 3 years of audits, depending on how big you are. We'll determine whether you need 2 or 3 years of audited financials. You'll need an independent board. You need D&O insurance, directors and officers insurance, very important. You'll need to hire an investment relations firm. This is very important and oftentimes undervalued by companies that go public, as small cap public companies. You have to remember that there's only one reason people buy your stock, and that's because they think it's going to go up. There's 1,000 reasons they'll sell it. I want a new car. I see another stock that I like better. Lots of reasons. So you not only have to sell people on buying your stock, you have to continue to sell them to stay in it. It's a very important process of being a small cap public company. You got to put some corporate governance in place. If you're already doing 100 million in revenue as a private company, chances are most of that governance is in place, but you may have to add a few more things, most likely. You apply for a listing at NASDAQ or the New York Stock Exchange, and then you go do an IPO roadshow, and now you have money in the bank, assuming everything goes well. That's the basic, the high, hard ones of what it takes to go public. What does it cost? Well, the cost is here, and I just wanted to contrast it because a lot of companies, when they're doing the analysis, they forget that a lot of the expenses of being a public company are expenses that you have as a private company. In fact, I'm going to go back. The hard cost for going public is about $500,000 to $1 million. If you're a micro cap company, you can probably get away with $500,000. If you're a small cap company, it's probably closer to $1 million. You can easily spend more than $1 million if you hire big international firms, law firms, and auditors. But that's just a ballpark range. How much does it cost to stay public? It's about $500,000 to $1 million a year, in that range. It can be more expensive and it can be less expensive, depending again on the professionals and how you manage it and how much money you spend. But I just wanted to contrast, as a private company doing 100 million revenue, you're still going to have legal fees, you're going to have audit fees. You should be doing audits by the time you're that size. You're going to have D&O insurance. Now it's going to be more expensive. All those things will be more expensive as a public company. But when you consider the additional expense of being public versus private, it's probably somewhere in the $300,000, $400,000, $500,000 to $1 million range. And I'd say on average, maybe about $500,000 a year extra to be a public company. Of course, there's lots of variables in that. All right, let's talk a little about different ways to go public. The IPO is the traditional way. It's an initial public offering where you get an investment bank, they go out and they sell the shares for you and raise the money. A SPAC is an acronym for Special Purpose Acquisition Corporation. That is also referred to as a blank check company. They go out, they raise money with 2 or 3 people. It's sitting in escrow. They go find an operating company, merge with them. The operating company takes over. they get the money, they're already listed, there's no roadshow, there's no IPO, that's already been done, and that's how SPACs work. The great thing about SPACs is you don't have to worry about market risk. So if you go back in time to March, April of 2020, right when COVID was breaking out, there was a huge pipeline of IPOs that companies had spent a lot of money on getting ready and preparing for it. And when the market blew up because of COVID, all of those IPOs got canceled. Some of them came back later the next year. Some of them went out and merged with SPACs. Some of them just died and never came back. So you have market risk when you do an IPO. That risk goes away when you do a SPAC because it doesn't matter whether the market's up and down. They have the money. You sit down, you negotiate a deal, and then the shareholder of the SPAC agreed to it, your shareholders agree, and the market is out of the picture. So that's one of the benefits of a SPAC. APO is referred to as an alternative public offering. That's where you have a public shell, and then you go raise the money before you merge with that shell. I did a deal like this with a Chinese fertilizer company called China Green Agriculture. It's an organic fertilizer company. We raised 20 million bucks at a $500 million valuation. We put the 20 million bucks into the shell the day they merged. We applied for an uplisting immediately to the New York Stock Exchange. 6 months later, they were on the New York Stock Exchange. 18 months after we did that deal, they were trading at a $500 million market cap. So when you do those deals the right way, they can be really successful like that one. A lot of people do those kind of deals, though, and make mistakes. Those are three major ways that you can actually become public. So let's talk about SPACs for just a minute and why it's not a four-letter word. Actually, the reason it's not a four-letter word is it's an acronym standing for 4 words, Special Purpose Acquisition Corporation. That was my little joke that apparently only I appreciated. So anyways, let me tell you why SPACs perform poorly. And this is really a lot of people think, SPACs, do a SPAC and the stock goes down. Has very little to do with the SPAC, although there is one thing. But the main reason why SPACs perform poorly is that the guys who raise the money for the SPAC and that are managing the SPAC are making bad business decisions and merging with companies that shouldn't be public. I'll give you a couple examples in just a minute. So if you go public and your company's not performing, you're going to get adjusted to the appropriate market valuation. And so that's one of the reasons that they don't perform well. The second reason is this 2-year deadline. So what happens with a SPAC is, and I was really this close to doing a $200 million SPAC myself and being the CEO of it. I had 3 different investment banks with engagement letters that were going to raise the money for me, and I had a great team, a CTO and a CFO. And the way it works, if you want to go out and raise money for a SPAC and then go find a merger and be a SPAC CEO, you have to come up with about $8 million of your own money, you and your team and the sponsors are the investors, and if you don't write the check yourself. And that $8 million goes to pay the investment bankers, the lawyers, the auditors, the whole transaction processing of the whole transaction. And what happens is you have 2 years to find a merger. If you don't find a merger in 2 years, the $200 million you raise goes back to the investors and you lose 100% of the $8 million bucks you put in. So why would anybody do that? Well, if you put the $8 million bucks in as a management team and sponsors and you do get a deal done in 2 years, you end up with $40 million of stock, generally speaking. So it's a pretty good return if you can get a transaction done. But what happens is these SPACs get close to their 2-year deadline where they're getting ready to lose $8 million or $5 million, depending if it's a smaller SPAC or a bigger SPAC. And then they get desperate, and so they make dumb deals. And those dumb deals, as soon as they get public, are going to go down. So that is why SPACs perform poorly, some of them, right? But it really has everything to do with the company. So if you're a good company, and I'll give you 4 examples here right now. Sarcos, anybody heard of Sarcos? They're a local company. They're a local robotics technology company. They went public at the height of the market, at the height of the SPAC craze a couple years ago. They were doing $4 million in revenue. They merged with a $240 million SPAC at a $1.3 billion valuation. And today they're trading at a $17 million valuation because they were way overvalued to begin with, and they just didn't perform. I think this year they're going to have revenue of, I don't know, like 14 million or something like that. So they just didn't perform, and that's why that SPAC was just a disaster. WeWork, that deal, they raised a 1.3 billion at a $9 billion valuation. They're now trading, they're bankrupt and they're trading at 13 million. Just not a good deal. DraftKings, that was one of the better ones. They raised 300 million at a $3 billion valuation. Now they're trading at $15 billion. Algamo Steel is raised 300 million at $1 billion, and they're trading at about $1 billion, about even. All these deals got done in the last 2 to 3 years. So it really has nothing to do with the fact that it's a SPAC and everything to do with the fact of what is your company doing? How is it performing? How is it really doing into the marketplace? So don't throw the baby out with the bathwater. SPACs can be a really great way to go public if you have a good company. All right, let me give you a few reasons why you should not go public if you're looking at the possibility of a small cap IPO versus like a $100 million private round. First, you have the cost of being public. By the way, the cost of going public, most of those costs don't hit your income statement. And the fee, by the way, this does not include the fee that the bankers get. The investment bankers get a commission, it's probably around 6%. If they raise 100 million bucks for you, they're going to get 6 million bucks. That does not hit your income statement, along with most of the other expenses you pay for going public. But also, some people don't want to be public because they don't want to make public disclosures. I think that's an unfounded fear, because if you look at the most technical companies in the world, the Teslas, the Microsofts, the Googles that have lots of things to hide, they're all public companies. So I think people that are afraid of public disclosures don't really understand how you can still protect it and be public. One of the other reasons you shouldn't go public is the CEO, you're going to have 30% of your time is going to be spent on public company stuff, work that you didn't have before as a private company. And then here's the number one reason why you shouldn't go public if you're a company doing 100 million, 200 million, $300 million in revenue. If you don't have a clear path to growth for the next couple years, you should not be a public company, because Wall Street worships growth. If you're not growing, you're going to turn into an orphan really fast as a public company. So if you've got a couple years of growth that look really strong in the pipeline, then you're a fantastic prospect for being a public company. If you don't, not a good idea, even if somebody's offering to do it for you. And then the last one, this is just my little poke at VCs. If a VC is offering you 100 million and you decide to do a $100 million IPO, they don't make any money unless they can deploy their money, right? So that's what they're looking for. That's their job. I don't blame them. If I was in that position, I'd do the same thing. But you've got investment bankers, they're going to make money when they take you public. So you got these two competing things, but at least you should be comparing them. That's the point today, is don't just not even think about an IPO. At least think about it and compare it. Well, let's get into what are the benefits of actually being a public company. What are you actually going to compare it to as a private company? So there's 9 benefits. I'll go through these really quickly in the next few minutes. Higher valuation is one benefit of being a public company. More capital available. It's faster, easier capital. You have liquidity. It's easier to attract and retain talent. Easier to acquire companies and IP and technology. It also elevates your brand and image. And this increased adoption speed for technology is really interesting right now with everything happening in AI. And then lastly, many exits, which I'll explain. But let me just jump into higher valuation. Public companies trade at a 50 to 100% premium to the equivalent comparable private company. Why is that? It's something called the liquidity premium. Liquidity premium says this: if I'm going to invest in, if I had the option to invest in 2 companies and they're the same size, same industry, same financials, everything, and this one I have to wait 5 years after I invest before I have liquidity, and this one I have liquidity every single day, I can get in and out anytime I want, I will pay a higher price for this liquidity. Instead of being locked up for 5 or 10 years, I'm not locked up at all. I'll pay a premium for that. So that is why public companies, on average, there are obviously exceptions to this, but on average, have a higher valuation. And one of the things you really got to consider, if you're a company that's doing $200 million in revenue and somebody's offering you a $600 million valuation to give you 100 million bucks, and you can get a $1 billion valuation as a public company, you need to think long and hard about why you wouldn't take the public company money at that higher valuation. I know your shareholders would probably want you to. More capital available. This is the reverse money pyramid, meaning if you're a startup, the least amount of money is available for the startups. These tech guys that were here all week, I went to a number of the events. That is the hardest place to raise money. I've raised a lot of money for my own companies at that space, and there's the least amount of money down here for startups. Then you get into revenue, a little more money is available. Then you're going to get into maybe getting some market share, and then you're going to get profitable, and there's more money. And then you get into the public markets, and there's $30 trillion. Now, not all $30 trillion is going to be available for small caps because some funds can only invest in large caps or these kind of structures. There's some funds that can only invest in small caps. And there's a lot of hedge funds that can invest in anything. But you have a lot of capital available as a public company, a lot more. And the more capital you have available, the easier and faster it is to actually raise the capital. Let me tell you about my IPO that I did, because I raised several rounds of financing before the IPO. Now, getting ready for the IPO is a lot of work, granted. You got to get the audits, and you got to get the bank, and the S1 registration, and all that stuff. But when you go out and do the IPO roadshow, it is something magical for all of you founders and entrepreneurs out there that are just grinding it out, raising $500,000 or $1 million or $5 million, whatever it is. You do the roadshow, and this happened more than one time. I do a 30-minute presentation on the company, usually with a room full of institutional investors, sometimes one-on-one, sometimes small group. And 15 minutes into the presentation, someone would say, okay, I'm good for $1 million. They just committed to invest $1 million based on a 15-minute presentation I just did. I never saw these investors after that. I never talked to them after that. And $1 million showed up in the investment bank account at the IPO closing date. So I did this roadshow, and literally in 30 minutes, people were making decisions on, I'll take $500,000, I'll take $2 million, I'll take $1 million, and then that was it. I didn't have any due diligence process with them because that's what the S1 has done. You do a lot of work ahead of time. But it's just so much easier to raise money once you're a public company because of all the public disclosures, all the audited financials, everything there is for the investors to see and to be able to do their due diligence without you. And one of the other stories I'll tell you about myself is a PIPE. This is something a lot of people don't know about until you become a public company. A PIPE is another acronym. It stands for Private Investment in Public Equity. And there's a lot of PIPEs done. This 2021, $139 billion. 2022 was an off year, obviously. 23, the first 3 quarters is $74 billion in PIPEs, probably be $100 million when they total it all up. I think 2024 will probably be well over $100 million. And most of that PIPE money is going to small cap companies. Warren Buffett loves PIPEs because when he finds a company he likes to get a big position, and he knows if he goes into the market to try to buy it in the public markets, it'll drive the price up. So he'll go to a company and say, hey, I want to buy 5% of your company. Would you like some cash? They negotiate a deal. They issue him shares. He sends them the money. His shares are restricted. PIPEs are not free trading shares. They're typically restricted for 6 to 12 months. And then they become free trading, but Warren Buffett doesn't care. When he buys companies, a lot of times he's buying them and just sitting on them for 10 years or forever. So this PIPE marketplace is very active. I raised a couple PIPEs after I was public. There was a company in another country that I wanted to acquire. I was looking to expand internationally. And I had the cash to go acquire them. They wanted mostly cash and some stock. But I decided there were some institutional investors that wanted to accumulate more of our stock. And they were interested in doing a PIPE transaction if I wanted one. So I got my board together on a Friday. I told them what I wanted to do, how much money I wanted to raise. They approved it. Literally 7 days later, the money was in my account that I had raised from that PIPE. So faster, easier is a very huge advantage when you're a public company. And there's many ways to raise money as a public company. There's the IPO, there's PIPEs, there's ATMs. And ATM means at the market. It used to be called a shelf offering, where you register shares, so they're free trading, and then you have them on the shelf. And then if you want to raise $500,000, you can just sell those shares to someone. Typically around at the market rate, whatever the stock price is. If it's trading at 12 bucks, that's what you sell them. You want to sell $5 million worth, you want to sell $20 million, you can do some this week. You can wait a couple months and decide to raise some more money next in another quarter. It's a very flexible financing strategy. Follow-ons are basically public offerings. They used to be called secondaries, but it's basically registering the shares, getting an investment bank, and then you just sell them all in a day. You know, they do a roadshow ahead of time. You have convertible debt, so you can get a $100 million loan that converts to equity at the predetermined negotiated prices before. And then, of course, you've got debt. And by the way, debt is also easier to get as a public company. Just basic commercial debt gets easier when you're public because the banks have all of your financials, the audited financials, and all the filings you do with the SEC. So banks are significantly more comfortable with public companies versus private, and it's easier for them to work with you. So here's a couple investment banks that do small cap public offerings. I want to just show you how active this space is. There's a lot of people that I've talked to, and during this tech week, by the way, I've been telling people about my presentation coming up, and they're all surprised when I start talking about how active the market is for small cap public companies. So I'm going to show you 3 different investment banks that all do small cap public offerings and just give you a sense. So Roth Capital is one of them. They're a great bank. I've worked with them in the past. You can see these are all IPOs they did in the last year, anywhere from a $15 million IPO to a $700 million IPO, and everything in between, 100 million, 200, 25 million. So very active. Here's another bank, H.G. Wainwright, that does small cap public stuff. And you can see everything from a $500 million at the market offering to $1.5 million pipe down here. And you can see most of the dates on these. These are all done in the last 30 days, by the way. There's a warrant deal, a private placement, $4 million pipe. It's another $4 million follow-on, $200 million follow-on, $6 million pipe. So it's actually quite an active space. Here's one last bank really quick. This is Joseph Gunnar, the IPOs they did, and you can see they did everything from, they were in the selling group for ARM, which was a $4.8 billion IPO, all the way to a $4.4 million IPO, and again, kind of everything in between. So let's talk about liquidity. Liquidity is really valuable. You can do lots of things once you have liquidity. Easier to raise money, it's easier to do options, and I'll get into some of the other benefits that come from liquidity. But one of the things you need to understand too is it takes work to develop liquidity as a small cap company, and you got to continue to work that and know how to do the investor relations. It's super important. And some of these small cap companies ignore that, and it costs them. But liquidity is really, really valuable as a company. As a private company, there is a secondary market that's been emerging over the years. Still problematic. Price discovery is an issue. So if you got employees or early investors selling stock while the CEO is trying to raise a round at a much higher valuation, it creates problems. And then you've got shareholders that you don't know. Some private companies want to be very tightly controlled and really know all the shareholders, and you kind of lose some of that control when you're doing secondaries in a private market. Acquire and retain talent. This is absolutely a ginormous benefit, especially now, and I think this is going to become more and more challenging for companies competing for talent. And if you are a public company offering stock options as a public company that has the stock options have liquidity versus a private company issuing stock options which may not have liquidity for 5 or 10 years, all things equal, you're going to win every time as a public company. And I'll give you an example. I had, as a private company, I hired 5, before I did my IPO, I went through 5 different presidents. And then I found this guy, after I went public, I hired this guy, Terry Kramer. He was running a company with 1,000 employees. I was able to recruit him as my president. He was a fabulous manager. He was so good, I eventually, after a year, I resigned as the CEO and made him the president CEO. And then unfortunately, a year later, he actually got recruited away from me by Vodafone to be an officer for the largest mobile company in the world. They moved him to England with his family. But that just gives you a sense of the kind of talent once you become public. I could have never, ever got somebody with that kind of talent as a private small company. but I was punching way above my weight as a small cap public company. Easier to acquire companies and IP. When you have stock that's liquid, that becomes an asset. And once again, all things equal, if you're a private company trying to acquire someone else versus a public company trying to acquire someone, the public companies almost always win. Because if you're using stock, the people being acquired are going to want liquid stock instead of private stock. So just as an example, by the way, as you can see here, Microsoft and Google, some of the ways that they grow, one of the major ways they grow is through acquisitions. They've each made over 40 acquisitions per year for the last 5 years. So being public gives you a huge advantage when you want to acquire companies. Elevated brand and status. It's pretty hard to beat the status of being a NASDAQ listed company or a publicly listed company. I was licensing my technology at QCOM to countries around the world that wanted to use it. And once I became public, it got way easier to get license deals. Again, they see you're public, they can see your financials, they can see how big you are. It's way easier for companies to do business with you when you're public versus private. And it's also easier to get PR and press because journalists can check out who you are. They have a lot more confidence in knowing what you're saying is accurate and who your company is. So elevated brand and status is definitely something that comes along with being a public company. Adoption speed, this is super important. AI is accelerating the rate of change of everything. I just went to one of the Tech Week investor meetings yesterday and bumped into a guy that's got this new AI product for furniture design. So instead of spending 50 hours with his app, you can do it in 5 minutes. And I keep seeing applications like that over and over and over again. We have someone in our audience today who is the CEO founder of an AI company called Enhanced AI, which creates workflows. It's a middleware company. It's a fabulous company. And they are like literally increasing productivity by 5 and 10x for the people that are using it. So what does that mean to you? Why would being public that be connected to being public and be an advantage? Well, here's my theory. The rate of change is going to continue to increase. It's going to increase this year, next year. The rate of change is going to increase more, and every year because of AI, it's going to change. And if you're not incorporating and staying up with the change, you are at a huge, huge disadvantage. So why does being a public company help you with that? Well, because as a public company, it's easier for you to acquire technology. It's easier for you to raise money really quick if you need it. It's easier for you to acquire talent if you need it. And so this rate of change that's coming at us, and it's going to continue to accelerate, it's going to be really important that you can get resources fast, which you can as a public company. And then last thing here, last benefit is mini exits. What do I mean by mini exit? Well, if you're a founder and you want to sell your company or raise a round, that's a final deal. If you sell it, you've got the money, that's it. If you raise a round, you're now waiting for your own liquidity event again for how many years. If you do an IPO, you don't have to sell any of your shares as a founder. Or if let's say that you're doing an IPO and it's a $500 million valuation, you're raising $100 million bucks, and your shares as a founder is worth, I don't know, let's say $100 million bucks. Well, when you do an IPO, it is perfectly acceptable for you to take 5 or 10% of your shares and take $5 or $10 million off the table right at the IPO and sell it into the IPO. Investment bankers do that all the time for founders. It's time to get a little payday, and then you can sit on your other $90 million. And if you have a lot of confidence in the company that's going to keep going up, you can just hold it forever, or you can have a selling plan where you sell 1% every quarter, no matter what the stock price is. A lot of founders do that, and you're putting money and you're diversifying your holdings. You shouldn't have 98% of all your wealth in one stock, and Wall Street understands that. So when I talk about mini exits, it means you can have a little exit at the IPO, you can have an exit every quarter, just a little money. 2 years after being public, if you want to sell another 10%, you can do that. You have to be careful about how you do it and the way the public perceives it. But if you're smart and you know what you're doing, you'll be able to do it in a way that doesn't spook the market and is good for you too. And of course, the same thing applies to VCs, employees, all the shareholders. They can all take mini exits, they can hold the stock, but they have the flexibility now. That's a huge, ginormous advantage of being a public company. So, so those are the 9 benefits of being a public company that you need to at least be thinking about when you're thinking about taking $100 million in a private round. At least do the cost benefit analysis. Sometimes it's going to make sense to take the $100 million private round. Sometimes it's making sense to take and go do a $100 million IPO. I was going to talk about this. I'm not going to. This is a little for VCs that do A rounds and they have portfolio companies that are thinking about doing a $100 million private round with another fund versus an IPO. There's a great way for those A round VCs to make money on a pre-IPO structure. I'm not going to get into it now, but if you're out there listening to me, get a hold of me and I'll walk you through how to make some good money on that. So the last thing I'm going to say before I finish up is, in addition to looking at the benefits of being public, when you're doing your analysis, you need to also be looking at the opportunity cost. What is it costing you not to be public? Well, you're going to have a lower valuation, so you're going to be diluting yourself more. Your capital is going to be more expensive. You're going to have a lack of liquidity for you, the shareholders, everybody. It's going to be harder to attract talent, harder to do acquisitions, and you're going to be competing with public companies that have all of these advantages. So keep that in mind as you're thinking about, do I want to do public? Do I want to take a big private round? And so hopefully you can all see that you do not need to be a unicorn to do an IPO and be successful and raise a lot of money and go up and become a $1 trillion company like Amazon. Thank you for your time today. I appreciate it.